Hello, and welcome to the Semiconductor Industry Association's public webinar series where we discuss topics important to the industry. My name is Robert Casanova. I'm the Director of Industry Statistics and Economic Policy here at SIA, and it is my pleasure to introduce today's webinar as Emerging Innovation, the Policies and Partnerships Needed to Support Semiconductor Startups. Before we begin, just a quick housekeeping note. During the webinar, if you have any questions, please use the Q&A function. To kick off the event, it is my pleasure to introduce John Neufert, CEO and President of SIA, to provide opening remarks and introduce our panelists. John, over to you.
Thanks, Robert, and thanks again, everyone, for joining us today. As Robert mentioned, I'm John Neufert, President and CEO of SIA. We're based here in Washington, D.C. Our membership is comprised of 99% of the U.S. semiconductor industry and 2/3 of the global chip industry. We are pleased to be with you for what I think will be a really great SIA webinar about the policies and partnerships needed to support semiconductor startups. Startups are and always have been an absolutely essential part of the semiconductor ecosystem, allowing us to explore new frontiers of chip technology. Unfortunately, startups in the semiconductor sector face significant challenges and barriers to entry. It's critical we work to overcome these challenges and foster an environment in which semiconductor startups can thrive, and hence our webinar today. To lead the discussion, we're thrilled to welcome Dan Armbrust, co-founder and director of Silicon Catalyst. Silicon Catalyst is the world's only incubator and accelerator for startups focused on semiconductor solutions. Its portfolio companies have raised more than $500 million in venture funding and are valued at $1.9 billion. Dan serves as an advisor, board member, board chairman, and angel investor to many semiconductor startups, and there's more. He's also working with Lawrence Berkeley National Labs, and he was appointed to an important body called the Industrial Advisory Committee, which advises the Department of Commerce on R&D strategy for the CHIPS and Science Act. Dan served as president and CEO of Semitech Semiconductor Consortia, and held various positions in semiconductor manufacturing and development over 25 years at IBM. I can think of no one more qualified to lay out the opportunities and challenges facing semiconductor startups and how we can work together to strengthen this vital part of the semiconductor ecosystem. Dan, thank you very, very much for being with us today. And without further delay, Dan, the floor is yours. Thank you.
Thanks, John, for a wonderful, warm introduction. I'm speaking to everyone from Sand Hill in the heart of Silicon Valley. We're at Mayfield, which is a prominent venture capitalist. And not only is it nice to have a natural background behind me, but I want to make an explicit connection between the importance of venture capital and investments and the success of semiconductor startups. So without further ado, let's get into it. I'd like to share my screen. There we go. You've read the title. In order to properly provide recommendations, I'd like to cover the semiconductor startup scene and the investment landscape as we sit here today. So let's get right into it. And I need to say that my remarks are of a personal capacity. I don't represent the Department of Commerce, the advisory committee that advises the department on the CHIPS Act, or the U.S. government. This is our journey. I want to set context, a deeper dive into startups, put that in context with help is on the way through the CHIPS Act, but we need more, leading to recommendations both for policy and for partnerships. I'm going to go through a lot of material fairly quickly, but the materials will be available along with the recording for you to look at later. So let's begin. Bottom line up front. There's no question that semiconductors are resurgent in terms of any reasonable financial metric. At the same time, AI is showing that we're profoundly hardware limited. In fact, we're in the next gold rush. And that's not hyperbole. The use of profound is best exemplified by reporting that Sam Altman was seeking to raise trillions of dollars to build data centers supplied by new fabs of silicon and the power plants to provide energy for the data centers and for the semiconductor fabs. That's the scale of the opportunity, because there's no one better than OpenAI to look at 5 generations of ChatGPT and understand the scaling principles necessary to get to generalized AI. That's the extent of the prize. You'll see in considerable detail that semiconductors face very specific and daunting challenges, and yet they're a vital part of our ecosystem. There's green shoots through the CHIPS Act, through venture capital, renewed interest, through M&A opportunities, and the advent of chiplets and advanced packaging to make it easier to innovate. But the recommendations speak to, even with the CHIPS Act, more needs to be done if we need to meet our goals. In fact, the challenge I want to offer is within the next 5 years, we need to at least 5x, if not 10x, the amount of investment going to startups. And you'll see in context why that's necessary and why it matters. So let's set context. Quickly, if we look through 6 decades of progress from the invention of the transistor, its transition to Silicon Valley, startups, and the invention of venture capital, to the scale up of revenue through generalized processors and memory, to some of the geopolitical considerations, the advent of the foundry model, which allowed startups to be successful and not have to own manufacturing, the beginning of consolidation, the disinterest and decline of venture capital in this area. Then we saw the rise of China, the rise of AI, Moore's Law slowdown, and in general, quite improved financials across the industry, leading to this decade where our drama has been around chip shortages, the passage of CHIPS Acts, restrictions specifically for China, and generative AI. So let's go through this quickly, but with some illustrations. First, with Moore's Law, on the top left, we have the doubling of chips on transistors on a chip at a predictable rate. And after 37 doublings, we're now at 100 billion transistors on a single chip, with a reasonable roadmap to get to 1 trillion transistors on a chip. By driving that improvement, we're able to lower the cost for any given function, which allows semiconductors to be more and more a part of electronic systems. That leads to improved revenues, and the industry is now crested over 600 billion, heading towards, by the end of the decade, $1 trillion revenue industry. And a portion of that is plowed back into R&D, which keeps this flywheel going, or virtuous cycle. So in the end, it is about investment, it is about dollars, and we need to explain where the startups fit into this. Beginning in the 60s, Shockley moving out to Silicon Valley, the spin out of Fairchild, and the investments in Intel led to really a valley of startups that invented semiconductors as we know it. Over the subsequent decades, the industry became more concentrated and more global. And this shows first expansion into Taiwan, first Japan for memory, Taiwan for foundry, Korea for memory and foundry, and ultimately to China. And you can see where today the United States holds still a majority of the market share. But the landscape being dominated by large companies that happen to be headquartered in individual places, but are actually acting globally. From an industry structure perspective, we mostly were comprised of vertically integrated companies that did everything, with perhaps purchasing materials and equipment. To work for scale and for scope reasons, we now are in a disaggregated industry where each of the components are dominated by a few and supplying system level integrators at each of the industry verticals. And just to illustrate that, we've had significant M&A activity year by year. The cost of a leading edge design is in the hundreds of millions of dollars. The equipment segments are all dominated by 2 to 4 players. We've gone from over 20 logic and foundry platforms to now 3. DRAM is dominated by 3, as is flash. And so with this, the industry has become quite profitable. In fact, it's the 3rd most profitable industry, and 8 of the top 20 market caps in tech are semiconductor companies. Along with that, we've had a roll-off of Moore's Law. First, we saw this with CPU performance, then with the scaling of DRAM and processors, and then finally the power density. As we've been moving down nodes, the power per area has gone, and this is in fact a huge constraint in the data centers today. That said, there are very strong roadmaps to carry us to 1 trillion transistors per chip, both at the transistor level, both for EUV lithography, getting to high NA and hyper NA, a series of advances to separate the signal and power planes, putting the power in the backside of the wafer or chip, and in advanced packaging, where we're moving to chiplets and tightly integrating them using near semiconductor dimensions at the packaging level. All of these things are going to be fueled by innovations from startups, and are going to keep us busy over the next 10 to 20 years. Another important aspect is all important system companies have brought internal chip design as part of their function. In fact, Samsung is integrated vertically, starting at the chip and moving all the way up into systems, both at mobile phones and other related systems. But this has been a really important part of the industry. So now, from a startup perspective, the challenge is you're not only trying to innovate and outdo other chip companies, but you've actually got to outdo some of the internal efforts at these system houses. Last thing I wanted to set context with is the geopolitics around China beginning in 2019. If we map the series of restrictions into the supply chain, you can see that they're fairly systematic, addressing access to equipment, access to manufacturing, access to design automation. And so here, through perhaps unintended consequences, we've bifurcated the semiconductor supply chain. And then returning to the most important aspect here is startups and venture capital. If we express the amount or the percentage of venture capital that goes into semiconductor startups, you can see since the year 2000, we've been on a decline to now, as a percentage of all venture capital, less than 0.5% goes to semiconductors. So let's take a deeper dive into what it takes to be successful in startups and how venture capital fits into that. Let's start with a progression of a typical startup over a period of 10 years, starting from when a few individuals, through self-funding, friends and family, or perhaps angel investments, gets up and started, oftentimes supplemented by grants from the government, SBIR, STTR, other government programs from the agencies that I've noted here. You can usually get your start with as little as $500,000, perhaps $1 to $2 million to carry you through the first year, at which point you're going to need to raise money from outside investors. This is where VC and corporate VC come to play with a larger round after you've met typically simulation, if not early minimum viable product sampling. The row actually begins at Series A, typically years 3 through 4, where a venture capital lead investor will come in with significant dollars to help scale the enterprise from perhaps 10 to 20 to up to 100. And in between each of these funding milestones, in funding events, there's a series of milestones or promises that are being met. And that's the key for why this is it's not a thing to have investments that carry you through 5 years. Monies are metered out carefully so that progress in terms of product market fit, in terms of technology de-risking, is constantly occurring. And it's not unusual to see semiconductor startups past Series C raising hundreds of millions of dollars before they go IPO or acquired through M&A. So that's the typical life cycle of a startup. Returning back to venture capital, in the left hand, it depicts the histogram shows the amount of venture capital investing. And here I'm showing US venture capital, noting that that's about 1/2 of all venture capital worldwide. Most of the other venture capital is coming from China. And it's a little bit more transparent to be able to report the US numbers, but recognize that there's about 2x the amount. If you look at the US today, it's about $200 billion annually. So that's just the size of the pie. On the right-hand side is what's going specifically towards semiconductors. And again, the definition of semiconductors is a little bit tricky, so results vary depending on how you look at the data. But roughly, let's call it $1 billion of the 150 to 200 billion. So this is where you get to 0.5% or less are going. You see a little bit of a rise through the pandemic years and then a decline. I'll describe that in a little bit more. But again, the goal here is how can we move from 0.5% of venture capital to something like $10 billion annually or 5%. That's what I want to speak to. Who's doing the investing? Well, it's spread out, but there are key players in venture capital and corporate venture capital. But just look at the scale of the investments. This is the deal count over a 10-year period. So even the largest VCs, most frequent VCs, are only investing in 1 or 2 companies a year. And in corporate venture capital, with the exception of Intel, again, numbers 2 through 4 are on the level of 1 investment per year, but it quickly tails off to 0.5 of investment per year. Looking at the last 10 years, while there's been an increase in amount of venture capital, that's been also matched by the level of acquisitions or IPOs. In fact, 2021 was a peak year, but coincident with the pullback in public markets for tech companies and for growth companies, where the pullback was as strong as 50%, you can see the window for exiting has essentially been closed off for the last 2 years. We're literally in winter in startup land. And the question is, does that continue and at what pain? Corresponding to the lack of exits, the limited partners are unable to fund new funding. And with a little bit of a delayed feedback, the amount of venture capital being raised has dropped accordingly. Now, a skeptic would say, looking at all VC investments, since there's a lack of liquidity, a lack of new funding, both the overall investments have tailed off. That was most acute at late stage, less acute at pre-seed and seed, because the nature of who's funding pre-seed and seed is less tied to the overall public markets. But a skeptic would say, well, okay, we had 2 boom years, but we're kind of back to where we were in 2018. That's not so bad. But from a perspective of a startup that got funded in 2021 or 2022, that's an acute problem because they need to continue to raise every 18 months to 2 years. And even if we're back to where we were, what happens to the startups that were funded in those years? The other thing I wanted to point out, just going back to where there might be green shoots, is while the IPO market has essentially frozen, just 2 weeks ago, Astera Labs, which is a semiconductor outfit which does retimers for the data center to extend the range of electrical connectivity, they're at a run rate of just over $100 million. And they entered the public markets valued at $5 billion. As of yesterday, they were in double-digit billions. And so the multiplier for success, if you're in a hot area and you've innovated and got to $100 million of revenue, the prize is considerable. And so we're hoping that that signals that the markets are getting back to a more normal, which would then tie into venture capital restoring back to normality. So looking specifically then at AI and machine learning, because you're saying, well, that's great, but how much is just going into one very specific area? And the answer is a lot. And in fact, venture capital in AI is roughly at the $50 to $80 billion level. That's about 20 to 25% of all venture capital. That's creating a lot of unicorns depicted on the upper right, but within the landscape of AI funding, the amount going specifically to hardware and semiconductors is a small fraction. That's depicted in orange, and you can see on scale that most of the money is going to AI applications, not AI hardware. There was a huge wave of semiconductor startups built around AI and machine learning, recognizing that we were hitting a data wall. The movement of data to the compute was a key issue. And so just depicting the startups that were formed in that period of time, both pursuing classical computing solutions with new accelerators or architectures, and those pursuing a merger of data and compute through either neuromorphic, which is an analog version of computing, through in-memory computing, where the logic and memory are merged, or using optical techniques for data communication and data inferencing. So this wave has come and gone. Many probably won't make it because the latest is the relevance of the generative or transformer models. There's a new wave of startups addressing that. It's even harder to depict that. But again, the gorilla in the room is, or the elephant in the room is the gorilla, which is how do you compete with some of the really large ongoing investments that are being made here. So let's spend a little bit more time with the VC model. Their goal is to raise monies in return to their investors or limited partners 3 to 5x over a 10-year period, which would be a compound rate of about 20 to 30%. They would typically invest their fund in 20 to 25 companies, and that represents just 1% or maybe 0.1% of the amount of startups that they actually see. Like Hollywood, it's hits driven, and all they need is 1 to 3 companies to have a major return for them to achieve their financial goals. So again, it's geared for scaling to succeed. Their compensation is, as a management fee, is 2% of the fund annually. And the payback is once returning capital back to the limited partners, they retain 20%, which is called carry on all profits. That fuels the venture capital industry. So the key here is that because the money is metered out in about 2-year increments, each startup has to go through a funding round led by a new VC to prevent the bias of, all my children are beautiful, I'm going to continue to invest on them. Although it's important that the investors have pro rata rights, which is the ability to continue to try to keep about the percentage of what they own through subsequent rounds. And so there's a number of, there's dry powder being kept aside to continue to fuel the startups. And then finally, with success, each venture capital firm can raise a series of funds based on their track record. So this is how the model works. So understanding that, then the question is, why aren't venture capital firms investing significantly in semiconductors? And it's for the reasons that you probably suspect. Over time, it's just been less financially attractive to invest in semiconductors compared to software and compared to services. And that is measured either through the capital required, hundreds of millions of dollars, the time it takes to revenue ramp, high rates of failure, longer time to liquidity, and therefore less attractive returns. So given that, question is, what can we do to change that landscape? Semiconductors are especially hard because while there's lots of semiconductor startups out there, it requires very specific and extensive due diligence. And that skill over time is mostly atrophied from venture capital. So while you can bring in outside consultants, it's always good to have a very strong personal conviction around your investment thesis, which has to start at the VC firm. And finally, I'd note that in contrast to software and services, the take-up of revenue and a product market fit takes longer and is less evident in the early years, whereas in these other areas, you can essentially measure that early on in the cycle and understand what your sell-through rates are going to look like as you add features and capabilities. So with that in mind, let's now pivot to talking about startups in semiconductors themselves. And through a survey of entrepreneurs, they were very clear in saying that while it does take a lot of time to be successful, the limitations here are if they can raise money, they turn those funds immediately over for design services to build the prototypes and validate that they actually work. And so the thinking was, if we could change the cost of prototyping and the ability to prototype, we could get more successes in startups. And further, looking at other industries, the uses of incubators and accelerators to provide the startups with lots of ancillary capabilities would be important for startup success. And so merging those two ideas, Silicon Catalyst got its start. And this just depicts essentially the function that an accelerator model does. Looking at startups that are spun up by entrepreneurs coming out of universities, spinning out of industry, is the source of them. Silicon Catalyst, through over 1,000, sees them across all the application spaces that you would imagine. And if admitted, the startups spend at least 2 years in the accelerator, surrounded by lots of things very specific to what semiconductor startups need. So overnight successes take about a decade to happen, and that was the case here. The original concept was around reducing the prototype cost for chip design. And after interesting a number of industry stakeholders and lots of individuals, Silicon Catalyst launched in 2015. Industry began to invest through strategic partners shortly thereafter, and connections to universities and other accelerators were added. Geographically, Israel, then the UK, and then the expansion into MEMS, sensors, materials, and manufacturing technologies has occurred over time. Most importantly, the connection to investors early on, then the formation of Silicon Catalyst Angels after 2020 that's made over 30 investments, and the announcement of the Silicon Catalyst Venture Fund, which both the angels and the venture fund are investing specifically in companies in the portfolio. To give you an idea of what it takes to help semiconductor startups, there's over 60 in-kind partners that provide services of what they do, either for free or heavily discounted. lots of advisors giving back. And a typical startup will go through many advisors as they go through different issues over the life. Lots of participation from strategic partners and investors. And so overall, we've brought in over 90 startups, and John mentioned raised over $500 million and counting. And finally, a depiction of the in-kind capabilities. You can see what startups need. They need design, they need IP, they need various services, they need prototyping capabilities, both silicon and back end, and lots of business capabilities. But what remains a challenge beyond chip design using process of record and standard PDKs and accessible nodes is what happens with these pesky startups that like to change things, because not that they want to, but because they can see that small changes, sometimes large changes, can make a huge difference in their solution. And so when we begin to make process materials changes, new equipment, new devices, new design capabilities, these require access to expensive production lines, even in the R&D stage of it, and it requires access to generally stakeholders that would prefer not to perturb their environment. And so these particular startups are even harder to move forward, and we'll talk specifically about what the challenges they face and what we might do about that. So let's get into then the CHIPS Act. In the US, it was signed into law by an act of Congress in 2022. It funded $52 billion and additional tax incentives, and 39 of the 52 went into specifically domestic outcomes for manufacturing across the supply chain. Already 4 of those have been announced through BAE, Microchip, Global Foundries, and Intel. There's over 600 preliminary applications, so this has been well subscribed, and you'll be hearing lots more about that. But relative to startups, the action is in the R&D sections of the CHIPS Act. There's $11 billion allocated for the formation of a new public-private partnership called NSTC, a packaging program called NAPMP, and $2 billion for the DoD Commons, or regional hubs for prototyping. So what is the intent of the R&D is not to just do more R&D of the same type, just more robustly funded. It's to address the valley of death, moving from a good idea that has shown promise, but there's nothing to really carry it to the point where industry is prepared to invest at scale. And so there's been a lot of work to describe what's missing in that valley and what we can do about that, but it's a lot about startups and accessing capabilities. So this just depicts this, where much of the research is done through partnerships with government and industry, but at the scale of roughly $2 billion of pre-competitive R&D. So if you think about $11 billion over a 5-year period, you're essentially doubling the amount of pre-competitive R&D. However, not just doing pure research, but looking at scaling it, transitioning it to the point where consortia will pick it up, professionalize it, and get it adopted as the readiness level gets closer to manufacturing. So advising the CHIPS Act in R&D, there's a committee set up by the Department of Commerce that included 24 of us individuals. And our responsibilities is to try to describe what's required in terms of the execution of the monies in the R&D sections. It's been up and operational for about 18 months. The real work gets done in working groups, and I've just detailed the charges that have been given to the Industrial Advisory Committee over this period of time, and highlighted in yellow are the areas I'm going to try to speak to, which relate to the success of startups and an investment fund. So first, the R&D gaps group, of which I've been the chair of. We describe the CHIPS Act as doing things in the R&D space that are grand challenges. That is, things that no single company could do and things that are not being robustly funded, so that we can not only do them, but do them quicker, so that we can intercept the roadmaps and pick up from the industry roadmap that we described earlier into what's next. And so specifically, we just described 5 capabilities that are needed. One of them is establishing accessible and affordable prototyping capabilities. And that's a very complex subject, even though it sounds like open a facility or use a facility and just fund it. The second is the recognition that chiplets is a emerging capability, coupled with our ability to package different functions at chip dimensions in a heterogeneous advanced package, is going to be where the action is going to be over the next decade. And then finally, specifically, creating and nurturing ecosystem for promising startups. So you can see how this specifically calls on the CHIPS Act to address startup needs that we've described. Another of the working groups went through and interviewed many startups and said, well, exactly what would you need? Where have you got stuck? And it turns out that the landscape is quite complex. And if you mapped a startup's journey across these 9 different wafer size, silicon, and packaging capabilities, a typical startup went through a complex set of landing zones and arrows as it eventually took its lab capability and moved it into high volume manufacturing. And so it's not only one thing we have to do well, we need to do these and sequence them all together. Then specifically around other voices for what startups require, the SIA issued 2 reports, one in 2019 and 2022, calling for expanded access to these prototyping capabilities for researchers and startups. The Presidential Council of Advisors on Science and Technology in 2022, coincident with the passage of the CHIPS Act, called for a startup investment fund. Again, noting the trend in venture capital, which we've reused. The recommendation was specifically to set up a $500 million fund. Another Washington, D.C. based think tank, the Special Competitive Studies Project, recently laid out their case and included recommendations around funding seed and early stage investments with a $500 million investment fund, and augmenting those capabilities with incubator functions to help chip startups. So in perspective, a $500 million seems like a lot, but that's just the size of just one venture fund, and a $500 million against over 5 years would be owning $100 million per year against a background of less than $1 billion. So it barely moves the needle. But what it does do is it takes a lot of early stage startups that can't get investment and matures them, de-risks them to the point where venture capital will then come in. And so while not significant in and of itself, it does dramatically increase the number of startups. And by providing the lower cost prototyping capabilities, it actually gives them the capability to demonstrate their ideas, whereas today, that's nearly impossible. Moving to the other working group that looked specifically at the investment fund, noting the calls for action from several organizations. They issued a series of recommendations. Again, these are all public and they can be accessed. I've got a link at the end so you can look at this. But specifically, the view here was that if we're going to have an investment fund that is originating out of the government, that needs to be different. It needs to rethink the premises around venture capital. It's not there primarily for financial returns, but it's really addressing weaknesses in the ecosystem. It called out specifically for investing in areas on the top right that we said are very, very hard to address and haven't yet been successfully dealt with. And the idea that there would be a lot of early shots on goal, de-risking the technologies with less shots married with existing venture capital. And finally, and perhaps disappointing to some of the audience, is the idea that it would sequence after the NSTC got its start, defined its priorities, and knew where startups could actually help its agenda. And so therefore, the question remains, well, if it's in the future, what are we doing here and now to change startups? I think an inspiration can be found in the United Kingdom. Now, they invested $1 billion last year in a strategy document and gave the DSIT the responsibilities to execute it. And in that strategy document, they talked about early stage startup program. Just 2 months later, that program was awarded to Silicon Catalyst UK. Within a month, 27 startups had applied, surprised all of us. 11 were admitted for a lightning 9-month program. And those startups have already read out in demo day at the first UK Semiconductor conference in March in over a decade. We're already in a second cohort of applications. So you can see a very fast timeline and only about £2 million spent to generate that type of result. So let's conclude then with specific recommendations. Now, some of this is acronym heavy and is a little bit of inside baseball. SIA gets that because they're all about policy and interfacing with the government. So bear with me there, but the intention is, how do we 10x the amount of venture capital and activity in semiconductor startups? And so the first is a straightforward recommendation, is execute aggressively what's already been authorized and appropriated with the CHIPS Act. Now, that's prototyping capabilities that are going to be stood up by the NSTC, the packaging group, the manufacturing USA digital twin for simulation and design capabilities, and the DoD Commons or hubs. There's 8 of them. They've already launched, and they're accepting proposals. The second recommendation is to get the NSTC Innovation Fund in place at a minimum of $500 million, consistent with the recommendations that we've described. The next is supplementing that execution with ongoing government funding streams. And these are very, very significant. You can appreciate what these, with various agencies like Department of Defense and Department of Energy, are annually allotted. The first is there are existing programs for researchers and startups, namely SBIR, STTR, and the Defense Innovation Unit. But we could really use a fast track for entrepreneurs to 3x the funding and improve the cash flow to these startups quicker. And this can be done with existing programs today. The second is there's ongoing funding streams. I've noted a couple of these, but these can provide demand signals, and they can provide demonstrating test beds for a number of startups. And the Department of Energy and the DoD have these in progress. We just need to do more of them and specifically target the emerging technologies that the semiconductor startups represent. There is even specific loan programs as you get closer to revenue. Then finally, complementing the public investments with attracting further private investments, again, with the goal of getting to about $10 billion or about 5% of all venture capital. Now, that's not unreasonable if you believe that we are profoundly hardware limited and we need money to return to get a better balance between hardware, software, and services. And so first, it's incumbent upon the corporate VCs to double their investments, not primarily because that's going to change the outcome, but because it's a strong signal to the rest of the investment community that their innovation is important and they care. That signal then triggers VC investments to get it to scale. Number 6 is we need more hard tech or deep tech and specialty funds that are gaining competency in these areas that can screen, mentor, advise, and help startups in these spaces. And there's, I think, an incomplete understanding of what incentives and policies could get us there. And so it would be, I think, appropriate that a neutral technology-based organization could study this and provide more specific recommendations. The seven is there's lots of work to attempt to have startups across all allied nations. The Office of Science of Technology Policy would be best equipped to be able to look across the various initiatives, coordinate those across the government agencies. That is their function, led through the White House. And then finally, a very powerful incentive is the tax code related to gains in early stage investments. There's something like a QSBS that affects some investments, but this is an area that, again, with favorable tax treatment, it tends to be a magnet for investments. So with those recommendations, we return to the bottom line up front now at the end, which is there's no question the semiconductors is the place to be. We haven't solved the startup ecosystem challenge, especially in materials, process equipment, metrology, and design automation. While there is a surge of investments coming in, we still need really good execution, and we need to supplement those with the things that I've described in the recommendations here. And so before we turn to questions, just to summarize, there's a lot of places to turn to if you want to learn more. Chris Miller's storytelling of the semiconductor industry was excellent and is a great place to start. For entrepreneurs, the interviews that Jessica Livingston of Y Combinator did were just extraordinary. And then the personal stories of Ben Horowitz, of Andreessen Horowitz, and Tony Fadell of Apple and Nest fame are just powerful lessons of personal struggles through startups. The history of venture capital, interviewing almost every major player, Sebastian's book is excellent. And then for entrepreneurs, learning how to tell your story and how to manage your boards, these two books are excellent sources of information. And then finally, some dynamic links into the various government programs that I've described, at least a brief. So with that, thanks for your attention, and I'm really excited to take your questions.
Thanks, Dan. Excellent presentation. We do have a few questions from the audience, but just to kick things off, I have a fairly high-level question, and it really goes back to the beginning of your presentation where you discussed the possibilities for AI, especially OpenAI and ChatGPT. We know in the industry that AI is going to be a major factor in demand for silicon or semiconductors by the end of the decade. What do you see? Well, besides AI, we're also looking at the automotive industry and the industrial manufacturing industries. What do you see as the top three opportunities in these other spaces for semiconductor startups?
By other spaces, you mean beyond?
Automotive, industrial, not just AI. And AI is going to play a major part in these industries as well.
Well, I can't pass to the question without just commenting that isn't it extraordinary that we have one company that's dominating training and to some degree inferencing in AI that has grown from 10 billion to 100 billion almost overnight. It's the most extraordinary product market fit we've ever seen. But it just points to there's so many problems in the data center in terms of networking thousands of chips together, in terms of the specialization that we're going to do with custom accelerators. OpenAI themselves are talking about having their own chip designs. They're certainly working with others as well. So I don't think we should just pass by AI and say, okay, we solved that problem. We are probably 1,000x off on our power and cost points for what is already compelling use cases, and we're just getting started. So I think the environment is really rich, just in very specific AI solutions. And then just the general notion that these models are quite useful in the areas that you're pointing me to. So automotive, clearly silicon carbide in the power generation and transformation is ramping dramatically for autonomous vehicles. We've never really solved the autonomous driving issue associated with LiDAR. And so we're probably off by a factor of 100 in terms of the useful compute to actually sense the environment and react to it in a affordable and powerful solution there. So those are specific automotive. In industrial, just the use of AI imaging to make sense of the industrial environment and react to things real time is a huge trend. And then I'm personally excited about the intersection of life sciences and semiconductors. Almost every emerging life science application is starting to use semiconductors, not just light to interrogate biological fluids, but electronics to do it far more accurately, more precisely. And so we're seeing a really exciting set of startups in that space.
Dan, John Newford, can I jump in here? The question. First of all, great presentation. Thanks so much. I learned a lot from it. I noticed on one of your slides, and maybe this is there's no correlation here. There's a slide, venture capital investment in semiconductor startups as a percentage of total VC funding. Up to about 2017, and falling off dramatically when there's been waves of consolidation in our industry, particularly most recent one in 2015, 2016. But then after 2017, it's been bumping up a little. Anything to comment about what's been happening in the recent years? And then is there any correlation between industry consolidation and VC interest in our sector?
Yeah, the bump up is AI. There was a little bit of LiDAR in there, but if you looked at all other areas, sort of bouncing around baseline. So the increase that you do see is AI, and depending on how you classify AI, it could be even a larger number depending on what a startup actually thinks they're doing there. So that explains the increase. But again, I argue that we're just off 10x in where we need to be to really support what our expectations are for innovation that's going to go into semiconductor manufacturing and design. Your other question, John?
May just be just be a correlation. Is there any connection between consolidation of our industry and VC investment interest in our industry, VC investment towards startups?
Loosely, there's just a concern of the power of a few buyers. VCs would prefer that there's 100 buyers rather than 3.
Right.
And so to some degree, but I would say that that's rounding error to the overall set of incentives here. So it affects it, but not too great. You see that primarily in the buying power and the risk tolerance of, all the solutions are at scale. And so what's the risk you take if you want innovation, a startup has it, and you commit your roadmap and your design wins to a startup? You've got to surround it with a very robust supply chain and lots of other things to get it right. And so in a way, what that drives is a merger mentality on the large players. They'll watch very carefully startups for innovation and for ideas. And at the point where they think it's relevant, they acquire. And to a certain extent, that may discourage some VCs that would like the outcome to be all the way to a viable public company. But again, I think that's not a major factor in what's going on.
Thanks, Dan. I think Robert, we have some more questions.
Yeah.
Came over
So Dan, one question from the audience. What is your perspective on the VC supplementing funds or cost sharing on programs being launched from NSTC or the DoD Commons? And a side question is also, once startups emerge out of the valley of death, the support and sustainability funds to get to the commerciality and outcome at the end.
Yeah, I don't see VCs being a source of funding for the specific programs within the NSTC or the packaging programs. That's going to have to come from industry stakeholders. It's just not the model. They're looking for robust financial returns, and they don't fund research, they fund companies. That said, I would expect a strong intersection with VC funded startups that need prototyping capabilities. And so big overlap there, and there's every reason to engage with them. And primarily that's going to be in education, which is they have track record, they have history. And the claim will be, yeah, but it's a lot easier now because we have these capabilities and we can go faster and with far less cost. Well, they'll be skeptical, and it's going to have to be shown.
Thanks. Another question from the audience. You discussed the energy and power requirements for AI, which will be expected to be enormous as we continue in innovation in these applications. Is there any specific initiatives around power semiconductors like silicon carbide, gallium nitride, to deliver efficient power architects for data centers running these AI systems?
The short answer is yes. Where the power is being consumed is data movement, by and away. Compute's a piece of that, and we certainly need more efficient compute, but it's the data movement which drives that. And so that's where the investments need to be. Power conversion, we're seeing gallium nitride and some discussions around silicon carbide for more efficient data power transfer, and that is definitely moving into the data centers and will be an important investment area. But by and large, it's the data movement. So anything that is addressing that, and there's lots of startups and established companies chasing various pieces of that. It shouldn't be lost on us that there's, in addition to the open AI investment scenario that I was describing in the beginning, that these are associated with, we need nuclear power back on the landscape, just to power the data centers and such. So I'll just reiterate my comment that we could use 1,000x reduction in power requirements just to make generative AI useful for just existing applications as we see it. So there's huge opportunities there.
Yeah, thanks for the answer, Dan. Just switching gears a bit, when we look at the workforce for semiconductor manufacturing, or just the semiconductor ecosystem in the US in general, finding quality engineering talent is very important. We know that this is a challenge for the US. What are some of the recruitment strategies for attracting more of these engineers to the chip industry that you see coming from semiconductor startups?
Yeah, a couple thoughts. First, the workforce working group in the Industrial Advisory Committee has read out extensively on their thinking around how do we get 100,000 more engineers over the next decade into the industry, and that's not driven simply by retirement replacement. That's increasing, folks. My personal thoughts is that we some of these pipelines, especially for diverse pipelines, are going to take time. We've trained a ton of software engineers that have all gone into tech companies that thought that semiconductors was not the place to be. So if we can simply make the industry as compelling and exciting as I believe it is, there is a huge reservoir of very talented, and when I think personally, none of us really understood semiconductors when we first started. We learned it on the job. And so you just take all that talent that has already demonstrated that they can learn and complex technical subjects. I think just putting them into semiconductors addresses a lot of the constraints that our typical startups see, which is software and design capabilities. The larger question around attracting workforce for semiconductor manufacturing is a more complex question involving technicians, and I'd probably just leave it unsaid and refer you to the Industrial Advisory Committee's work there that I can't do it proper justice in the time we have here.
Thanks, Dan. We're at the top of the hour. We do have a lot of other great questions from the audience, but we don't have time to answer them now. But we will have answers posted on the SIA website, along with a copy of the presentation and a video recording of the webinar. Dan, thank you again for a great presentation, and we look forward to seeing you all on the next SIA webinar.
Thanks for hosting.
Thanks, Dan. Great work. Really appreciate it.